quick rundown to go through the key views from Morgan Stanley on the outlook for interest rates. So, look, three broad points I want to cover off here. First, what we're seeing globally, where I'm really going to lean on my global colleagues. I cover the Australian economy, so I can't own all of these calls, but I can certainly parrot some of their key views, some of the differences we're seeing in Australia, and then also stepping back and looking at some of the long-run trends and what we're seeing there. So look, to kick things off, obviously the key debate over the past couple of years has been inflation. To be frank, the story from inflation last year was pretty easy. It was high and it came down. That was kind of the story for basically every DM economy. The good news is it has come down, although it's still not at target. And I think the key message from our macro teams across the world is that the path from here is going to be a lot bumpier, right? And we're already seeing that from the US. You can see on the right-hand side there, left-hand side, some of the measures there are starting to tick up, and that's really because we are seeing more persistence, particularly in the services side of the inflation components. Things like housing, things like some of the medical and healthcare services, and even travel are all holding things up higher. Our view is still that this comes down, but I think particularly from a rates perspective, we're going to see slower progress and more cautious commentary from central banks around embracing this. Another key reason why the inflation progress is going to be slower this year is because the macro backdrop is pretty strong, right? Like if take the right-hand side chart there, right? Those are GDP forecasts for the US. If you look at the left-hand side of that chart where we were started last year, the story was essentially recession in 23, mediocre growth in 24, right? We ended up hitting 2.5% growth in the US last year. Current view is that that's going to be above 2% this year, right? So the backdrop's strong, and you can see that in the jobs market, you can see that in spending. We still think it's enough to get inflation incrementally coming down, but we're not seeing that roll over into recession that was pretty much consensus at the start of last year. What does this mean for central banks? I think the good news for most central banks is that they have hiked rates so that they are in pretty restrictive territory, right? And that allows them, we think, even with this pretty solid backdrop, to take the foot off the brake a bit, right? We don't think the resilience that we've seen is enough to stop rate cuts coming through, but we do think when they come, they're going to be pretty cautious, right? If you look at what's priced into markets, it's now kind of broadly in line with most of our economists' expectations. Our US team were forecasting 4 rate cuts from the Fed. At the start of the year, the market was pricing 7 or 8. It's now back down to around that 3 to 4 mark. We think that's pretty fairly priced. I think the key message I'd point to here is that this cycle we think central banks will be cutting because of inflation, not growth. That sort of easing cycle has not happened for quite a while now, and we do think it'll make for a much more gradual easing path than what we've seen in the past. Australia is somewhat different. On the sort of economic backdrop, things are pretty similar. Growth is slowing, inflation's coming down, although there's sticky components. Where we see a bit more difference is on the policy backdrop, right? The RBA has hiked rates by less than most of its comparable central banks. It's at 4.35. And importantly, that's not a view that it thinks medium-term rates should be lower here than other places, right? That's about providing less restriction. It also means that the bar for them to pivot towards easing is a bit higher versus some of those other central banks that have hiked rates to more sort of 5.5 levels. So we do see that pivot being a bit slower there. The other key difference is the fiscal backdrop, right? Unlike almost every other DM economy, we have a lot of fiscal space. We've got low debt, we've got a budget surplus. There's room for the government to spend more, and I think you're increasingly seeing some of the commentary from them move towards that direction. So we see stimulus coming through this year for Australia. We think it is going to be a bit more fiscal than monetary. We don't have the RBA cutting rates until early 2025, which does make it on the later side versus some of our DM pair forecasts. So that's the sort of the 12-month view, right? We've got most central banks cutting rates over the next 12 months, sort of starting from mid-year, and by early next year, basically everyone's easing. but it's a lot slower than what we've seen in the past. Stepping back, I think the key question around rates is really whether the long-run trend we've seen lower has actually been broken, right? I think short-term, there are some relatively compelling arguments. Sticky inflation expectations, more active fiscal policy, that means that we do think rates will be in restrictive territory for a bit longer than they have been in the past. But there's also some pretty powerful long-term dynamics going on here, right? Demographics, larger debt loads, a shift from income to wealth that haven't meaningfully changed, at least in our view. And so we'd be cautious about extrapolating this high rate environment for the very long term. We do think these longer run dynamics will take hold at some point. And the final chart I wanted to leave with, which is one I've used in the past, but this is from the Bank of England looking at long run rates. This downward trend is a very, very long run feature, right? That is not a typo, that's 1317 on the side of the axes there. Don't ask me how they got the data, but you can see, this is driven by things like income and wealth distribution. This is driven by things like demographics and the build-up of debt. These things play out over long periods. I'm not saying it's going to be the driving factor over the next 1, 2, or 3 years, but I think it is something important to keep in mind around the very long term. And with that, I might hand over to Rob to close things off.